Imagine having the worst timing of any investor alive. Every single time you put money into the S&P 500, you do it on the exact day the market tops out. October 2007, right before the worst crash since the Great Depression, and you watch 55% of your money disappear. You never sell. And over the long run, you still make 10.8% a year, better than the market's own long-term average. Some of those investments stayed negative for years before they finally turned a profit. But the money was never touched, never sold, never second-guessed. And that is the whole lesson. Timing the market is not the hard part. Leaving the money alone is the hard part. So here are 5 growth ETFs the traders agency analysts like right now. What they actually hold, what they have returned, and the overlap trap hiding between them. Timing is not the hard part. Leaving the money alone is. First, the boring base. VOO, the Vanguard S&P 500 fund, holds the 500 largest public companies in America, weighted by size. Its cited 10-year return is 15.5% a year, enough to turn $10,000 into about $42,000. That is the floor of the portfolio. Backward-looking, not a forecast, but the longest record on this list. Because VOO is weighted by size, your money is not spread evenly. Every $1,000 in the fund puts roughly $76 into Nvidia and about $6 into Costco. The giant companies get the biggest slices. That is not a flaw in the fund, but you should know the bet you are quietly making every time you buy it. Now the engine. SMH holds the 25 largest semiconductor companies listed in the US and nothing else. No software, no banks. Its cited 10-year return is 34% a year. That same $10,000 becomes roughly $186,000 versus $42,000 from the S&P fund. And one rule built into the fund is doing a lot of that work. The fund cleans itself. No single holding can grow past about 20% of the fund, so winners get sold down and the money flows back into the rest. Here is the price of that return. In 2022, SMH fell 45% from peak to trough. That was one of 4 declines of at least 27% since 2018. The long-term number is real, but you earn it by sitting through drops that would shake most investors out. Third, DRAM, the Roundhill Memory Fund. Only 12 companies that make their money from memory chips, and Micron, Samsung, and SK Hynix carry roughly 75% of the whole fund between them. The reason it exists, the AI buildout ran straight into a memory wall because every AI chip needs memory stacked right next to it, and not enough is being made. That memory is forecast to compound at 25% a year through the end of the decade, the fastest growth in this entire analysis. Then the 2 wildcards. NASA holds 38 space companies inside a cited $600 billion industry, but many of its holdings are not profitable, and the fund is down more than 40% from its late May peak. QTUM spreads across 89 companies at roughly equal weights, but only about 12% of the fund is directly tied to quantum computing. Both are real themes. Neither is a pure bet. Here is the question almost nobody asks. How much of the same thing do you actually own? Add up all 5 funds in equal amounts and the answer surprises people. Nvidia sits inside 3 of the 5 and ends up at 5.9% of everything you own. But your biggest position would actually be Micron. It sits in 4 of the 5 funds, and it is a quarter of the memory fund all by itself. Equal buying turns one memory chip company into 7% of your entire portfolio, ahead of Nvidia. You never picked that allocation. Nobody added them up for you. And this is exactly why the NASDAQ 100 fund did not make the list. QQQ genuinely beat the S&P fund over the last 10 years, but it is 49% of the same fund as VOO and 32% of the same fund as the Semiconductor ETF. With those 2 as your backbone, QQQ is a remix squeezed out from both sides. Before you add any new fund, add up your total exposure across everything you already own. If you want to build positions like this with a real plan, go to startwithtA.com. You get daily market briefings, real trade setups, and the levels that matter from the traders agency team. Start your journey at startwithtA.com. The link is below. That's the briefing from the traders agency team. Subscribe for daily market analysis, This is education, not financial advice. Trade smart.